right, I think we can get started. A very warm welcome to everyone who's joining us for the inaugural AI and Big Data in Finance Research Forum. This is our first symposium in the symposium series. As you know, ABFR has long hosted a popular seminar series, which we try to bring together scholars from around the globe to share new research and ideas at the intersection of AI, big data, and finance. And the symposium is designed to provide a broader, more interactive venue for this academic exchange. So unlike our seminar series, the symposium series is not structured with formal discussions. Instead, each presenter engages directly with the audience, summarizing their research, all tied to a common theme for each symposium. So we encourage open dialogue. At the same time, we do invite a very distinguished senior panelist who will lead the Q&A panel. Our goal is to make this format useful for junior scholars, a space where new ideas can be shared and refined and strengthened through lively discussion and collaboration. Now, each symposium is going to be recorded and posted to our ABFR YouTube channel. We are just delighted to have you join us for the first symposium. So thank you for helping us launching this. The symposium will follow the following format. We'll have 3 papers for today's symposium on the common theme of AI and big data in the investment industry, touching upon mutual funds, hedge funds, and so on. Each paper will go about 20 minutes. Please be respectful to the speakers and only ask clarification questions. During the paper presentations, we encourage you to post a question through Zoom Q&A rather than asking directly. We'll save 15 minutes towards the very end to have this Q&A panel led by the distinguished senior panelist. Over there, we can discuss and comment on the papers as well as explore how the research should be going in this on this general theme. So our first symposium, as I mentioned, centers on the theme of AI in investment funds. We're going to explore machine learning and data-driven techniques that are transforming the way these investment funds operate. We are very glad to have Maxime Bonelli from LBS, Jinfei Sheng from UC Irvine, Yiming Zhang from Nankai University, as well as our senior panelist, Kaniel from Rochester, joining us. So without further ado, I'm just going to pass the stage to our first speaker, Maxime. So Maxime, you can share your slides here.
I hope you can see my slides now.
Yes.
Is that okay? Okay,
yeah,
perfect.
Yes, we see your slides.
So good morning and good afternoon, everyone, and thank you very much for the opportunity and invitation to present this paper, which is actually a joint work with Thierry Foucault from HEC Paris, and which is part of a broader research agenda, I would say, on how the advent of so-called data technology, so think about AI, machine learning, big data, is actually reshaping financial intermediaries' role, firm investment, and potentially the allocation of capital in the economy. So the motivation for this specific work is actually this tremendous rise in the adoption of such techniques that we've seen in many industries, obviously financial services, but also think about healthcare, education. We now all face this data deluge, quote unquote, which is obviously changing the way we make decisions in our jobs. And one way to think about this trend is that, well, on the one hand, we have new data. So think about big alternative data. And on the other hand, we have new forecasting tools, I would say, so machine learning, for instance. And basically, this is changing the way, the sources and the way information is processed in many jobs and in many tasks. And one direct consequence of this is that this calls into question the role and the value of what I will basically describe as traditional expertise. So in other words, will institutional knowledge, domain-specific experience remain a competitive edge or competitive advantage, or just be, overtaken by data science skills or data-driven decision-making? And one case in point where this tension is particularly obvious is active asset management, right? So first of all, this is an industry which is quite interesting because the value of expertise can be to some extent quantified, right? If you think about the performance of a fund, the performance of a fund manager, this is a measure, a monetary value, so to speak, of the value of expertise. And this is also a sector where this tension between data science skills and more traditional skills have been around for decades, right? If you think about this contrast between what we usually call the quant funds that are relying on large computing power, big data sets to make their investment decisions, as opposed to more traditional or discretionary funds who rely more on traditional expertise, networks, deep knowledge of a given industry. And I'm just showing you here the screenshot of one article from the Financial Times focusing on BlackRock, who's now quite vocal and obviously betting more on machines, so to speak, rather than traditional fund managers. And I think one quote from this article illustrates quite well this distinction between data science skills and in traditional skills, what they call the foxes. They say the foxes, the quants are the foxes of the markets, right? They know little, but about a lot of securities. And if you think about more traditional investors, they are the hedgehogs, right? They know a lot, but only about a specific corner of the market. So there's a little bit this notion of being very deep about a few stocks or very super wide, but knowing kind of a little, this notion of scaling a certain type of expertise. So the question we want to ask in this paper is, how does this new availability of alternative data actually affect the value of traditional expertise? And in other words, discretionary expertise of fund managers. And if you think about that, well, the answer is not really straightforward ex ante, right? Because it depends on whether those data actually provide information that is kind of a substitute or a complement for the traditional expertise, right? So you could think of a world where those alternative data are actually providing information on exactly the same fundamental of a given company as the fundamental that is researched by those traditional experts, right? And in that case, that's a pure substitute case. The availability of those data are going to reduce the performance of traditional fund managers. You can think about a complement case where if those data provide information on another dimension, on another fundamental of firms, well, maybe in some cases, this can actually improve the performance of traditional experts because you're going to have like an uncertainty reduction effect. So ultimately, this is an empirical question that we believe has not yet been studied in literature. And this is what we want to tackle in this paper. So what is the methodology? We face first a challenge, which is how can we measure how fund managers are exposed, so to speak, to alternative data, right? Because if you think about alternative data, well, the quantity of data actually varies from one security to another. And if you want to aggregate that at the fund manager level, well, that's going to be very difficult to define what is the exposure of a fund to alternative data. So the strategy we're going to be using is that we're going to be using a shock that is really at the security level, at the stock level. So think about some companies that suddenly are covered by alternative data. What we're going to be using is actually the staggered coverage or introduction of satellite data images for some companies that are publicly traded. Those companies are actually large retailers in the US. So think about Walmart, Home Depot, those type of companies. And they've been tracked by Arithmetric. So Arithmetric is the first data provider for satellite data images, providing and tracking parking lots. So typically, they're going to collect those satellite data. They're going to count how many parking lots are there on those pictures, how many cars they can count. And then they're going to sell you like a large and big CSV file telling you on each shop how many cars there are. So this is going to be our shock to the quantity or availability of alternative data at the security level, because different firms, different companies are covered at different points in time. So this is the shock we're going to be using. Then essentially, we're going to be using a definitive setup in which we're going to be comparing active mutual funds, stock picking ability, and I'm going to be clear on how we define stock picking in a minute, in those specifically covered stocks before and after the introduction of the coverage. So that's going to be our first diff, so to speak, before and after. What's going to be our control group? Well, we're going to be looking at the exact same funds, stock picking ability, but in stocks that are not covered by the data provider. So that's going to be really a within fund analysis where we're comparing how stock picking skills evolve before and after coverage compared to stock picking in other stocks that are not covered. And then we're going to be running triple differences where we're going to be comparing whether the effects we find are actually stronger for what we call the traditional experts that are more likely to have expertise in the first place and that we want to zoom in into. So what are the main findings? Well, the main finding is that on average, what we find is that first stock picking ability in those covered stocks, they drop after the stocks become covered. And this drop is actually large. That's about 1/3 of the standard deviation. Given that the average fund in the sample has no stock picking skill, you can imagine that 1/3 of a standard deviation is already quite high in the distribution. That's already above the 75th percentile. So that's really pushing funds towards the no skill point, right? This effect is actually much stronger for the funds that we qualify as traditional experts. So who are those funds? Well, those funds are funds that have high before coverage picking ability in those stocks, funds that have a high industry expertise, or funds that are that can benefit from a geographical proximity to those covered funds. The drop in stock picking abilities is much stronger for those traditional experts, consistent with the expertise being to some extent, quote unquote, displaced by the availability of those alternative data in the market. The effect is actually weaker for funds that have some quant characteristics. How do those traditional experts adapt? Well, what we find is that they actually reduce their holdings in those covered stocks, and consistent with the comparative advantage, well, they will reallocate their assets, their capital towards non-covered stocks that are relatively similar in the same industry, in the same location, but that are not covered by those alternative data. What's the overall mechanism? Well, just to close the loop, well, we actually find that cross-informativeness increase for those covered stocks, meaning that there is indeed less scope for those experts to exploit their private and specific information. So let me describe very briefly the data we use. So we rely on three main data sets. So the CRIS Mutual Fund database that we all know, I guess, the CRIS Mutual Fund holdings to have exactly each quarter what are the stocks in each mutual fund portfolio. And we also directly collect and get the data from this data provider, RSmetrics, which is on top of providing us the huge CLV file I described with all those parking lot information. We know the exact date at which this data provider starts covering the retailers in the samples. And you have about 50 stocks that start being covered. What is important is that you have papers in the literature showing that there is indeed information in those data. It can be used to forecast earnings, to forecast sales. So this is really a data set that's going to be helpful. Here I'm just showing you the staggered coverage over our sample period, just to see that, it's quite spread out over time. So how do we measure firm skill? Remember, we need something that is really fund stock level, not just a fund alpha, something that is really fund stock level. So we're going to be using a measure of stock picking ability, which is defined as follows. If you think about the fund F, investing in a given stock I, we're going to define stock picking as the product of the tilt of the fund with respect to the market. So how much the fund overweights the stock I compared to the weight in the market, and what is the excess idiosyncratic return of that stock over the following quarter, 2 quarters, 3 quarters, 4 quarters. The idea being, do you tilt the portfolio in the right direction at the right time? This is the measure of stock picking, essentially, right? So picking is going to be positive if you tend to overweight stocks when the price increase in the following months, or if you underweight stocks when the price tend to decrease. We can think about all the definition of tilts that we test in the paper and in robustness checks. I'm just going to show you this, the results with this standard definition, but you can think about tilt with respect to an index or trading, tilts with respect to your previous weights. Everything goes through with those alternative definitions. Okay, so just the summary stats, as you can imagine, well, the median and average fund has 0 stock picking ability, quite consistent with the literature, but actually you have substantial heterogeneity across funds and stocks. So what about the results? This is the strategy I described initially that we're going to be employing. This diff and diff, comparing the changes in picking abilities in covered stock versus non-covered stocks. So on the left-hand side, our dependent variable of interest, it's going to be this stock picking measure. So remember, this is a measure that is fund stock quarter level. And on the right-hand side, the main term of interest is going to be this interaction over time post, which is really the stock quarter level, right? So for a given stock, is the stock covered and is it post coverage initiation? We're going to have stock fixed effect just to control for fixed stock characteristics. So basically, that's going to be pre-post. That's this diff, and we're going to have fund times quarter fixed effects. So as I said, this is going to make sure that everything that is time varying at the fund level, think about the size, think about like the team size as well. Well, we're going to be absorbing those changes in these fixed effects. So that's going to be really a within fund comparison where we're going to be comparing like changes in picking ability in covered versus changes in picking ability non-covered, right? So the usual diff and diff identification assumption, well, that's the fact that those picking ability must evolve in a parallel way with and without coverage, right? This is kind of the usual diff and diff assumption in this within portfolio, within fund setup. So what are our main results? So first of all, as I mentioned in the preview, well, you see that the effect of coverage is actually strongly negative across the different horizons we consider. So stock picking ability declines and then declines significantly by approximately 1/3 of the standard deviation. So that's a large effect. As I said, this is about the 75th percentile of the distribution. You can do an event study instead of putting this coefficient on just the post. Well, you can have specific coefficient on each quarter before and after the coverage, just to look at what's the dynamics of this drop in picking. And what you see is that, well, before this dashed line, there is essentially fluctuation around 0 that are not significant. And post, after this dashed line, you see that this is where you have this dip, which is basically the most negative after about 4 quarters. So think about like 1 year after those data are released, those data have been kind of purchased, processed by market participants, and this is where you see the large drop in the stock picking ability of the funds in our sample. And even though this fluctuates post, you see that long term there is no reversal towards the initial level. So this seems to be like a permanent decline in the stock picking abilities of those funds. So that's the first result. The second set of results are actually about the heterogeneity across funds, right? Is it the case that experts that has a form of traditional expertise in the first place to obtain their signals, are they more affected? You can think about funds that had high picking before, funds that are industry experts are shown in some papers. When funds have like a portfolio that is highly concentrated in one type of industry, they tend to outperform because they are experts in that industry, or funds with geographical proximity because they can potentially, directly observe a proxy for the sales or even directly interact with the management to get some private information. So we're going to test this hypothesis by looking at a triple diff specification. So just like I've shown you before, this is picking on the left-hand side, and I'm just augmenting this specification with a triple triple interaction, which is cover and time post interacted with expert. And expert is going to be one of those measures of fund expertise so that we can test whether the effect and this decline in picking is actually stronger for those funds that are flagged as expert in the sample. I just want to emphasize that in those specifications, we can also include fund time stock fixed effect. So basically, you can really control for the match between a given fund and a given stock, just to make sure that the results are not really driven by a composition effect in which you can imagine that, oh, maybe some funds are exiting the market, you have a new wave of funds entering that are maybe of lower quality. Well, actually, when you fix the fund stock match, you're sure that the effect is actually estimated by looking a given fund holding a given stock post pre and post coverage. So the first measure of expertise is quite agnostic. We're just going to be classifying fund as superior stock picker if they have picking ability above the median in the pre-coverage sample. Okay. So high picking pre, this triple interaction term is actually the interaction between covered post and a dummy, whether the fund is above median in terms of picking skill on that specific stock pre-coverage period. And you see that actually the effect is mainly concentrated on the funds that were good stock picker pre-coverage, right? So those funds, those superior stock picker, they seem to be the most negatively affected, consistent with their expertise being kind of displaced by the availability of those alternative data. And if you look actually at the event study, so if you do the same event study that I've shown you before, but separately for the cover time post, so to speak, and the cover times post time high picking pre-period, on the left-hand side, I'm showing you the quarter dummies for the interaction but just for the inferior stock picker. And you see that basically this is fluctuating around zero, nothing really changing. So the funds that were bad, they're still bad post-coverage. Nothing changes for those funds. However, on the right side, you see that those funds that were the superior stock picker, again, you have this strong decline in their picking ability, and it seems to be like a permanent drop with no recover afterward. So that's the first measure of expertise, which is quite agnostic. We consider another one, which is industry expertise, right? And first of all, we're going to define industry expert as, do they have more than 75% of their portfolio invested in the industries where those stocks are covered, right? So mainly think about the retail sector. This is essentially what this is capturing here. And what you see is that, again, while the triple interaction is significantly negative and much larger for those funds. So those industry experts seems to have a decline in their stock picking ability that is much stronger than the average fund in the sample. This result is actually the same if we use sector funds or dummy defined by the style of those funds and whether they invest in those retail sectors. Finally, the last measure of expertise is a measure of location. So what we call local experts, consistent with the literature, is funds that are close to the stocks in which they invest, right? So the way we're going to define close here is whether they're located in the same MSA as the stock's headquarters, or the stocks where the MSA where the covered stocks has the highest number of parking lots, because we can observe the parking lots location for those specifically covered stocks. And what you see is that, again, for those local quote-unquote funds, well, it seems that their picking ability is more significantly affected and then decline even more.
Maxime, just a reminder on the time. You have about a minute and a half left.
That's perfect. Thank you for that. Perfect. So those measures of expertise seems to be more displaced. This is what I wanted to say here. In terms of how experts react, well, we would expect them to react by exceeding those covered stocks and to have a form of portfolio reallocation if indeed this is a comparative advantage story. Two ways of exiting: intensive, you reduce your weight, or extensive, you just drop the stocks. And this is actually what we find in the sample. We find evidence for both. On the left-hand side, you see that the stock rank, the covered stock rank in those fund portfolio goes down. So even conditioning on staying in the portfolio, the weight goes down. And on the right-hand side, you have the number of funds holding those covered stocks, which is actually declining. So at the extensive margin, what this means is that some funds are actually dropping those stocks out of their portfolio. I just want to emphasize here, if you interact this effect again with measure of expertise, what you see is that this is indeed those experts that are divesting the most, consistent with the expertise, again, being displaced and triggering some form of capital reallocation. I'm just going to finish up by closing the loop on the mechanism. Is it the case that price informativeness goes up, consistent with this idea that you have less rooms to trade on that private information that those experts had in the first place? And we're going to test whether price informativeness grows up for those stocks with two measures: absolute cumulative abnormal return and jump ratios. And what you see is that for both measures, actually, those measures of jumps or price reaction post-earnings are actually smaller, meaning that throughout the quarter, you have more information that is actually included in the price, and the stock price reaction to earning announcement is smaller, consistent with price informativeness going up. So I'm just going to conclude here by telling you that this paper is showing you that the emergence of data or alternative data seems to reduce the value of those traditional expertise. Implications for labor, new skills required. Is there still a role for this traditional expertise? And also capital markets, potentially on the information generation process between stocks that are covered versus non-covered. And I'm going to stop here to be on time. Thank you.
Thank you, Maxime, for staying on time. We'll just have Jinfei share the slides for the second presentation. In the meanwhile, Maxime, if you want to reply to some of the questions posted in the chat, please feel free to do so.
Let me have a look. Yeah, so I see a question on, is it the case that those old-fashioned funds understand that their lack of expertise in new data coverage and then decide to go away? I cannot tell you directly whether they understand, but the fact is that their performance is declining and they tend to exit. So if you look at the timing, as I said, stock picking declines in about 4 quarters. If you look at the timing of reallocation, it's between 4 and 8. So it's consistent with those funds having time to observe that indeed their performance is going down, and therefore they react to that by reallocating their portfolio towards other stocks. Yeah.
And so
Thanks.
this
Yeah,
reallocation
Jinfei, you
happens
want
in a
to
year or so.
guess?
Sorry.
Maxime, let's save the question to the Q&A session towards the very end.
Yeah.
Let's
Yes, sure.
proceed with Jinfei's presentation.
All right. Thank you. Thank you for the invitation. Thanks for having me. So the paper I will present is generative AI and asset management. So Maxime's presentation is great. Is great in terms of set up the stage. You know, nowadays, not only we have new data and alternative data, we also even have alternative tools, right? New tools. So I'm going to talk about, you know, how generative AI as a tool affect the asset management industry. This is joint work with my excellent course and colleague Zhang from UC Irvine and my excellent course Zhang from Georgia State and Adam from Iowa State. So the big motivation of this paper, if we think about it in a traditional finance framework, information is the key to success in the asset management industry. Right? Many people in this audience contribute to the literature. And if we think about it in classical models in Grossman Stiglitz, it shows sophisticated investors can earn off either by engaging in costly search for new information or processing the data in a timely manner. Right? So, however, doing that is not easy, right? If the investor can easily do that, and then we don't need the finance industry to begin with, right? The fact that we have a huge finance industry that says that we need to the whole industry to search the data and process data in a timely manner. Just little showing that doing that is not that easy. Now, even before generative AI, we have been have a kind of a couple of about 2 decades of using AI like machine learning, and there's literature showing that not only finance industry, right? The whole many of the industry, they're using AI technology to to improve their production, etc. There's newspaper mentioned about this, the broad application of AI and etc. Now, what is relevant to in the finance setting is, well, AI has been also relatively technical, right? I know many of people in the audience doing machine learning, right? You know that we all code up in Python, etc. to run the code, running all type of models. Well, this is doing that is not that easy, and also transfer the AI technique into performance in the fund industry is not that easy. One main challenge was AI talent, right? There's newspaper mentioned that they need to find the AI talent and find the talent to do the jobs, and also it's not that obvious whether you just use AI, this gonna help the fund with great performance, right? So there's news article, the debate in the industry saying that it's not that easy actually, right? It's not that easy to using AI to transfer that into auto performance. Anyway, now fast forward to 2022 that we had a big milestone in the AI space, which is generative AI, right? One big example is ChatGPT. So this is relatively new. I'm sure the many people in the audience even know better than me about generative AI as a tools. But let me make sure that everyone on the same page. Essentially, what generative AI does is that essentially it leverages a huge amount of texture data and also huge amount of parameter, so that the tool is very powerful when it comes to predicting text, what the next word is going to be. This become a very popular and very successful application. ChatGPT is the fast app to reach 100 million users, which is only 2 months, right? So therefore, it's very important from financial industry perspective to understand how wide this tool has been used in the asset management industry and what's the implication, right? So that's kind of the motivation of the bigger motivation of this paper. This is easy to talk, but it turns out actually it's not that easy to study, right? That's kind of we dedicate this paper to explore these questions. So what we do is we propose a novel measure of investment company reliance on generative AI, and we mostly focus on hedge funds. We will have a little bit about mutual funds, but it's not going to be a lot of that. We're going to mainly focus on hedge funds. Because the reason is that they're relatively, always regarded, they're always front runners when it comes to using, the new data and new technologies, right? And as Maxime present, they're using these satellite image data, and also we're going to show that they're actually pretty timely when it comes to new technology as well. The research question, the specific research question we want to ask is, are generative AI tools widely adopted by hedge funds, and what implication might be such adoption have for their performance? And so just a quick result review. I only have 20 minutes presentation, so I think I will just give you a preview and then present the key results. So what we propose is so-called relative reliance on generative AI. In this measure, we try to capture the degree to which fund managers' portfolio decisions are influenced by generative AI information in addition to existing fundamental signals. We have various models various methods to validate this method. And then once we have this measure, we try to understand whether funds who have a high generative AI reliance outperform or not. We found indeed the hedge funds with a higher generative AI reliance can earn better returns. Then we also try to look at a little bit about the economic mechanism in the sense that how does generative AI help hedge fund performance, right? One, we look at it in three channels. One is whether there's because they can complement with AI talent, right? And we found indeed this is the case. We also look into whether generative AI is good at analyze certain type of information than the other ones, right? And we found that the generative AI is better analyze firm level information rather than macro information. And in this case, it helps in the funds to analyze firm level news information such as conference call, etc. We also look at whether the trades are aligned with the generative AI signal and whether this helped with the returns, and we found indeed this is the case. We did actually run a new survey in this year to directly provide some evidence whether there's a lot of people, a lot of hedge funds using the generative AI and how they use it. Both provide as validation for our main measure, and also try to get some new insights about what's going on in the fund industry when it comes to generative AI. And we have a bunch of other results with other data and etc. Anyway, without further ado, let me actually quickly go through the. I'm not going to skip the data. So I'm going to jump into how we think about one key hypothesis about this paper. Try to test is that in the fund industry, one key use of generative AI is try to use generative AI to process text data, right? This is also confirmed by our survey data as well. So what we do here is we essentially ask ChatGPT to read through earning conference calls, right? And then we ask the following questions: over the next quarter, how do you think about the firm going to change in the employment, right? The answer going to be, if increase, going to be 1, and no change is 0, and if decreasing, it's going to be -1, right? So that's kind of the setting that we want to use. Of course, in the robustness test, we expand the text data to include the 10K, 10Q data, also include Wall Street Journal. Right? So this is just, we focus on earning conference calls first, but we have robustness data to show you that we found similar result by expand the text data. In total, we have about 14 signals. Essentially, these are the usual suspect, right? If you want to look at these, after you're reading these conference calls, what do you think about the company going to do in the next quarter, right? We have all these AI signals that from ChatGPT. Now, once we have this, we try to measure how funds are going to use these signals or rely on these signals. For that, we rely on a framework constructed by Kapchek and Sulu in 2007. What they do is they try to measure the reliance of public information for mutual funds, right? And And now building on their method, right? And what we do here is we try to look at how much of the holding changes is due to fundamental signal, and how much of holding changes is due to fundamental signal plus AI signals. We're gonna focus on the R square from the following integration in equation 1 and equation 2. And then we take the difference between these R squares, and this is gonna capture what's the incremental information explanation power from this AI signal when it comes to explaining the holding change in hedge funds, right? So that's kind of the generative AI reliance measure. Now you may have a lot of questions about how good this measure gonna be. I'm gonna later on provide you some evidence. Now I think one advantage of this measure is that it directly from portfolio change of the hedge funds, right? So it captures the use of manager for investment purpose rather than the other purpose. And also another advantage is that we focus on the 13F data, which allows us to cover a broader set of hedge funds, right? So this allows us to have systematic analysis. We do actually have a survey that is pretty, I would say, pretty well responded, but we still have relatively small sample based on the survey data. Once we have the generative AI measure, we then construct the adoption rate. This as a validation. We can think about in the percentage of funds with significant partial F test for each quarter, and this gonna measure how much of the hedge funds are actually using the generative AI tools. What you can see here is that it's pretty flat, right? Pretty flat until 2022. Of course, we also want to admit that the measure is not perfect. There's false positive rate here. We can think about it 2%, right? Even then, no generative AI, there's about 2%, and there's always there flat. But then once we reach 2022, when the generative AI was introduced, there's big jump, right? As you can see, and there's also big jump around the way, right? Since 2022, and right now we have got about more than 60% of the hedge funds are using the ChatGPT as of in 2024, right? So this actually the pattern of this adoption rate showing that actually all measure does a good job in capturing the adoption of ChatGPT. Now, once we have this measure, we want to understand that how generative AI reliance affect the fund performance. So what we do is that we run a difference regression, and the first difference is before and after. The second difference is just different level of generative AI reliance, and we found that the coefficient on the interaction is positive significant. What does this mean? This means that in hedge funds with a high reliance, the generative AI reliance outperform after ChatGPT was introduced. Right, so this provides evidence that indeed, using ChatGPT or generative AI actually improve their performance. Right, that's kind of the key takeaway from this result. We not only look on the raw return, we look at different type of alphas, and doesn't matter what the measure we use. This all give us a similar story. We also look at non-hedge funds. We are a little bit coarse here. In the 13F, we have one type of hedge funds, and another one is non-hedge funds. We found the evidence with the non-hedge fund, it's not that much, at least, and as far as we have in the sample, we found that the effect is not significant. We did look at in the paper, not in here, but we did look at in the paper. Look at a more active hedge funds, mutual funds, right? If we look at a very active mutual fund, and we found there's a little bit of evidence that using generative AI help the mutual fund performance as well if they are very active, but not broadly. We also look at within the hedge funds. We also look at and whether certain hedge funds doing benefit more than the other ones, right? One quick key question we had is whether generative AI, help lift the playing field. We found actually it's not. We found that the effect is stronger for larger, older, and more active hedge funds. So it seems that the good ones are doing better with the new tools, not the weaker, small ones that can use the technology to catch up. Anyway, now I also want to quickly go through about how does AI help hedge fund performance. We look at several channels, and there's one channel actually. There's one channel is about human capitals. What we do is we look at whether the hedge fund hired a bunch of AI skilled workers before ChatGPT launched. Where this help their use of generative AI tool, and we found this indeed is the case. Right? So we found this. We at least in this setting we found the complementarity between generative AI and human skills. We also look at different type of data, and we found that generative AI is good at analyzing the firm level informations. We also look at the tradings, and we found that if the trading is aligned with the generative AI signals, they ought to perform. And if not, sorry.
Sorry to disrupt. Have about another 3 minutes.
Fantastic.
I hope you don't have another 30 slides.
Sorry, a lot of them are appendix. Sorry about that. The slides looks very scary. I know there's 60 pages of slides. I know there's yeah. Anyway, great. 3 minutes, perfect. Now is actually perfect timing for me to share some exciting results from new survey. What we did is, we have this paper. I think we believe our measure, which is great. But we also have, a question that, in reality, what do these hedge funds doing with the generative AI? So what we did is we actually hired a company to run the survey. We spent about 4 months actually to design everything and to do the whole thing. So what we do is that in our sample, we have our sample. We have the total sample we have is about like 400 companies, and we hired a company to run through. They have good connection with the fund industry in the United States, and then what they did is in the end we got 33 hedge funds, which is pretty good. I mean, we're talking about 10% of response rate in hedge fund, which is pretty great. And we also showed, not here, but we also showed in the paper that this hedge fund sample is very comparable in terms of our main sample, in terms of both the fund size, etc. These are not small hedge funds. In fact, these are big hedge funds, right? And we also know, who are these people responding in the survey. These people are fund managers, right? Some of them are even chief investment officers, right? So these are like not like rank and file employees. These are actually major decision makers in these hedge funds. So and anyway, we asked a bunch of questions. Our paper actually have in the appendix we have this list of questions that we ask, and what I'm gonna show you, just want to show a few graphs. So what we look at is first question we ask is, are you using generative AI for your investment purpose or not, right? And we found that about 70% of said yes. This is very similar to what we got from our main measure, right? You remember that we have about between 70-60% of hedge fund adoption rate. We also ask them, when do they start adopt the generative AI tools? Interestingly, I did a quick survey when I doing presentations in different audience in academic settings. We use ChatGPT right away, right? When ChatGPT become available, and as professors, we use ChatGPT for teaching research right away. While in the fund industry, they are a little bit more cautious, because when it comes to investment decisions, right? They start using in 2022, but the big adoption is in 2024. We ask why they are we have some other questions. It seems that they want to wait for new tools. They want to wait until they find that this tool is reliable and etc. Right? But we also look at this. We use this data to validate our measure. By look at the adoption rate over the years. This is a similar pattern to our main measure. We also look at how they use ChatGPTs, right? A big assumption we use in the paper is that we assume that hedge funds use ChatGPT processing and analyzing text data. So this is the case, right? 91% of the adopted hedge funds, they are using that for that purpose. Well, they will help their trading strategy, but mainly they were just using for processing the text data, right? And there's other information and another validation for our main measure. There's also a couple of new other insights as well, but I'm running out of time. I will just quickly conclude. Our paper is the first systematic analysis of generative AI adoption in the asset management industry, and we provide novel measure, and we show this novel measure have a sharp increase when ChatGPT introduced. And we found that in funds, if they use ChatGPT more or generative AI tools more, they tend to outperform. And the outperform is due to in using AI talent and analyzing certain data and also along with the AI signals. We also have a new survey among hedge funds to provide validation to confirm these insights. And we also have some additional new insight from survey as well. Thank you very much. That's all.
Thank you, Jinfei. Feel free to respond to questions posted in the chat box. You can just type directly there. And let's move on to our third paper. Yiming is going to share the slides.
Okay, let me share my slides. Okay, can everyone hear me? Okay,
Yes.
let's begin. Hello, everyone. Many thanks to Professor Will's invitation to today I'm very glad to present my paper in ABFR. This is my job market paper, and recently I'm revising it based on the feedback I collected on the market. And the new author Zhang is an expert on texture analysis, and he helps me a lot on improving the AI measure. And now let's begin. Whether to adopt the new technology or not is a very important question for both researchers and practitioners. There are a lot of papers in this area. In practice, the outcome of early technology adoption can lead to different results in different cases. Now let me give you two examples. Amazon's early and aggressive adoption of cloud computing technology through AWS turned out to be good. But in contrast, General Electric launched a big digital transformation plan in 2011, which leads to their financial troubles later. So in this paper, we want to study the AI technology adoption in the mutual fund industry. So as we all know, AI has become one of the most significant technology breakthrough of the past decade. And one of the basic functions of AI is to generate forecast by identifying historical patterns, which makes it well suited to the investment industry. So as a result, asset management firms have heavily invested in AI recently. As you can see that the human capital investment ratio for AI tripled after the 2016, and I will give you more detail on this graph later. And these days, AI help fund managers process, analyze insights from large data set. And here is a real-world example. It is an article from New York Times. It discusses that a powerful software system called Aladdin, developed by BlackRock. So recently, they have incorporated some AI technology into the Aladdin to improve its ability on data processing and analyze. So based on all these motivations, I want to ask two research questions. The first one is, do mutual funds adopting AI technology perform better? You might think, of course, the answer is yes, but actually not necessary. So in its early stage, AI is still relatively immature, and stock investing is a challenging task. Besides, there is also a risk called AI evolution, which means if all the mutual funds use AI in the same way, then it would cancel out any advantage, and none of them can make money. So this question remains an open question. So the second question is on the channel. If so, how do mutual funds benefit from the AI technology? So our main findings of this paper can be summarized as follows. First, we develop a new AI measure based on hiring practice, and we document that mutual fund industry demands more and more AI talents after 2016. And next, using portfolio sorting and regressions, we find that mutual funds with a high ratio outperform non-AI funds. A long-short portfolio delivers an annual excess return of around 2.83%. And then we study where the outperformance come from, and we find that it comes from the improved stock picking skill. So which type of stock contribute to this improved stock picking skill? So first, we find that the AI adoption helps to migrate the declining in stock picking skill due to the alternative data. And the second, we also find that mutual funds that adopt AI technology tend to tilt their portfolio towards stock with a large amount of information, and these stocks contribute to their better performance. Next, the literature. So our paper is related to 3 areas, but now I want to skip the broad discussions and just focus on few recent papers that are closely related to our research. One is this one by Chen, Selim, and Xu. So this studies AI technology adoption by registered investment advisor. For example, they're looking at which types of advisor are more likely to adopt AI. And another paper by Huang and Yu found that AI adoption increases the short-termism of the mutual fund manager, and they also discuss some real effect of the AI fund ownership. And of course, the other 2 papers presented at this seminar are also closely related to our research. So compared to their findings, our main contributions are as follows. So first, we develop a new AI measure by combining Babina's 2024 method with texture analysis, which can better capture funds' AI hiring. And second, we are the first one to show that AI adoption can improve the mutual fund performance. Other papers, such as Chen's paper, they focus on other impacts of AI adoption, such as the growth of AUM. And the last point is on the channel. Some papers like the Huang and Yu, they also find that AI can improve the ability to process information, and we provide direct evidence to show that the improved ability lead to the outperformance of the mutual funds. And we also support the conclusion of Sheng's GFE paper in the mutual fund setting. Okay, now let me introduce how to construct the AI measure. So guided by a few previous literature, we develop a new measure based on AI-related hiring. So we define 4 core AI skills, that is artificial intelligence, machine learning, natural language processing, and computer vision. And then we calculate the correlation of currents of each skill S with these 4 core AI skills using this formula. And then we calculate the AI score for each job posting J by taking average of AI score of all the skills. So all of these steps are just from Babina's 2024 GFE paper. So here, let me show you 10 examples of job posting with high AI score. So from these examples, you can see that there are 2 potential problems when we apply the general method into the mutual fund industry. One is that the hiring is conducted at company level, and it might be for other sectors. For example, Goldman Sachs might conduct hiring its new employees for its investment banking sector rather than the asset management sector. And second, there are some jobs that require similar skills to AI jobs, but actually they're not AI jobs, such as this one, IT audit. So to address these 2 questions, we utilize GPT-4 to determine whether a job posting belongs to the asset management sector and whether it is AI related. So this graph just summarizes the whole process, and it also shows the number of job posting in each step. So here, let me give you some more details. I just use the previous 10 jobs as examples. So this is the first part of the prompt we use to determine whether a job posting belongs to asset management sector. So as you can see, GPT-4 consider the first one, the second one, and this one are not from asset management sector, which is consistent with our intuition that they are from banking sector. And then we do some prompt engineering to GPT-4 because we want to avoid its divergent thinking. And to be specifically, we give a detailed definition to GPT-4. So to sum up, the AI related means that a job directly involves AI. So weakly AI related means a job might use AI in its daily work, or it indirectly supports the AI system like the data scientist. And not AI related means a job has nothing to do with AI. And we also use 6 examples to teach the GPT-4 the logic of the judgment. And here is the second part of prompt we use. So the prompt is very long, so I just show up a part of it. So here, GPT-4 considers a machine learning engineer as AI related, a quantitative risk specialist as weakly AI related, and an IT audit as not AI related, which is consistent with our intuition. So, and then I translate these labels into numerical scores using this formula. And this step is our novel improvement for the measure in the literature. And this figure shows the general trend of job posting, overall job posting. So as we can see that it increases rapidly around 2017 to 2018, partially due to the launch of Transformer. And also we provide two examples. And as we can see that the overall their trend is consistent with the general trend, but it is more noisy at the company level. And this is the final step. So we calculate the labor stock. We turn the job posting into a labor stock using this formula. Here, L is the labor stock. It equals to the labor stock in the last period adjusted by the separation rate plus the new labor adjusted by the vacancy fill rate. And here is an example of how to calculate the labor stock. And the final step is to get the AI ratio, which is my final measure. Is use the labor stock in AI divided by the total labor stock. And the labor hiring before 2017 Q2, we use as treated as formation period to calculate the AI labor stock before. And this table shows the summary statistic. So our final sample contains around 22,000 found quarter observations from 2017 Q2 to the end of 2022, and we only keep domesticated active equity fund in our sample. And here, as you can see that on average, there are around 18 labor recruitments for every 1,000 recruitments. Now we developed our measure for AI, so we want to answer the first research question. Do mutual funds adopting AI technology outperform? We use two methods. The first one is portfolio sorting. We sort the mutual funds into 5 portfolios based on their AI measure. We rebalance the portfolio at the end of each June and December. And we use 3 measures to measure the performance: raw return, alpha from CAPM, and alpha from cohort 4-factor model. And as you can see that in most cases, the alphas are negative, which is consistent with our prayer that active mutual funds are on average, they are losing money. And we also calculate the difference of performance between group 5 and group 1. So it can generate 0.236% excess return per month, correspond to 2.83% excess return per year, compared to the mutual fund literature. So this magnitude is relatively large. And then we use regressions to test whether the AI ratio can predict the future performance. And the independent variable is the AI ratio, and the dependent variable is the cohort alpha. So here, different columns correspond to the different control variables. And we also lag the AI ratio for 1 more quarter because it takes time for the AI labor job posting to affect the fund performance. And the main takeaway from this table is that after we adding the control variable, so the AI ratio can predict the future fund, positively predict the future fund performance. And here it might be a little bit surprising to see that mutual funds with a high AI ratio outperform, because theoretically, if AI adoption can improve the fund performance, then all the funds should adopt AI technology and none of them can make money. But in reality, AI technology is still rapidly evolving, so the mutual funds can continue benefit from using it. So in one sentence, we are still in a transition period. Here I also plot the AI ratio distribution. So as you can see that even at the end of 2022, so there is still a large variation in on the AI ratio. So, and next we want to further investigate the mechanism of the outperformance. So the first test is to decompose the fund performance into stock picking skill and market timing skill. We just using this formula to calculate. It's from Charismatic 2014 GF paper. And we use these two skills as the left-hand side variable and run the regressions as follows. So here we can see that the outperformance mainly comes from the better stock picking skill. And in column 3 and 4, the coefficients are also positive but not significant, indicating that mutual fund might slightly improve their market timing skill. But still, stock picking skill is a broad concept, and we want to know which type of stock contribute to the outperformance. First, we borrow the difference in different setting from Bonelli's paper by comparing the fund stock picking skill on covered stock before and after the satellite data release. Okay, this part of the results are new and still a little bit preliminary. Since their paper is also in the web seminar, I will not repeat the detail. So we test the heterogeneous effect on AI fund versus non-AI fund, and we recalculate the skill on the stock level to be consistent with their paper. And we also include an AI dummy, so and add it into the regression. So the AI dummy equals to 1 if the AI ratio is above the median in that quarter. And this table shows the regression results. And we also plot the dynamic effect of the release of the alternative data on fund's stock picking ability. So the left-hand side figure is for the fund whose AI ratio is above the median, and the right-hand side figure is for the fund whose AI ratio is below the median. So the main takeaway from these figures is that for the fund sets with a high AI ratio, so with a low AI ratio, their stock picking skill declines after the release of the satellite data. But for the funds with a high AI ratio, their stock picking skill does not drop. So it suggests that at least some mutual funds that adopt AI technology can take advantage of this alternative data. So this gives them an information advantage when they analyze stocks. And it also provides a piece of causal evidence that AI adoption improves mutual fund performance. So motivated by the previous result, we want to ask a more general question. That is, does the adoption of AI technology improve the information process ability of the mutual funds, which gives them an advantage on stock with large amount of available information? Here we borrow from Sheng's GFE paper for 3 variables to measure the information amount. So in their paper, they suggest that small firm, new firm, and firm with less information events need more subjective human judgment. And AI is good at dealing with big firm, old firm, and firm with more information events. So the 3 measures for is market cap, firm age, and number of information events. So it comes from capital IQ key development data and tracks a variety of major firm information events, and it can give it can measure how much information is available for a company. And we aggregate this fund.
Yeah, you have about a minute left and we want to wrap up. Yeah.
Okay. So we aggregate it into the fund level, and then we run the regressions as follows. So, and this is the result. And basically, we find that fund with a high AI ratio tilts their portfolio towards stock with large amount of available information. And this is the final result. Basically, we want to show that the outperformance of this AI mutual fund driven by stock with large amount of available information. And this in this table is a little bit that with the mutual funds with a high AI ratio, they only have skill conditional this subset of stock, that is stock with more information events. And this is our conclusion. Okay, that's all for my presentation. Thank you for listening, and I'm looking forward to your comments and questions.
Thank you, Yiming. Now it's time for our panel discussion. Ron, please take the lead. Ron has done great work. Probably the earliest contribution to this area, this line of research, machine learning AI applications in the fund industry.
Thanks, Will. Thanks for having me over in this session. Before I'll give a few big picture comments in terms of where I think this specific literature is going. And when I say this specific literature, I mean literature that looks at the introduction of either Gen AI or AI more generally. This is actually I'd like to thank Will because I also have a recent paper that as opposed to Jinfei, which shows that AI creates inequality. We actually have it's a very short paper that basically looked at the impact of Gen AI on academics. And what we show is actually that it actually levels the playing field in terms of citations. So there is a lot of, I think, activity and understanding what happens when you introduce Gen AI and when you introduce AI in general. A couple of small points, partial equilibrium and then general equilibrium. So first, the adoption of Gen AI or the adoption of ChatGPT has been very fast. So, it was introduced late 2022. And within a year and a half, there were already like 100 million users. Now, two of these papers here focus on this adoption issue. Maxime's paper is a bit different. And one thing which I think people should think about going forward is basically what's happening in the time series. So the time series currently is very short. But all these differences that you're finding in the time series, for example, Jinfei is finding differences between hedge funds and mutual funds. The question is how quickly these differences are going to shrink or potentially disappear because other institutions are adapting this very quickly. The second question or broader question that I think is interesting to look into in these domain is basically how does this impact the correlation in trading strategies? So all these papers, all three papers were looking at except for Maxime, which looked at inefficient, the informativeness a bit. In general, the papers were looking at at the fund level or at the stock level. And I think an interesting question is, given that everybody's using the same ChatGPT model, how is that actually impacting trading strategies of funds? The last point that I'm going to make before I open the floor for questions has to do with price impact. So Maxime looked at informativeness, but I think this is actually a bigger question. The bigger question is, everybody's starting to use these Gen AI tools. So for example, a lot of code now is being written by Gen AI, and that potentially is going to shift the distribution between funds that are quants versus funds that are not quants, because now it becomes a lot easier to be a quant fund. That might change the distribution of quant funds. That might have, in general, an impact on price processes of underlying stocks. The more trading you have driven by these tools, it's going to change the dynamics of the prices. And more generally, it's potentially going to change the factor model or the asset pricing, the underlying asset pricing model. Now, personally, I think this is a very important question. At the same time, I think really deciphering this question and understanding, how is this impacting the asset pricing models is actually quite a challenging question. But again, I think this is, it's a very exciting period in terms of these things are changing very rapidly, and many people are adopting AI on multiple dimensions, and it's impacting both practitioners a lot, and also us as researchers. I think it's having a very big impact. So now I'll open the floor for questions. Now, Will, how do we do the questions? because I just see the ChatGPT. I don't see like a large screen that allows me to see, you know, hands or stuff or something like that.
I think the audience can raise hands to ask questions. I'll just take
Okay, because for
advantage of
some
my
reason the
phone.
screen I see is I see the speaker and then I don't see. Let me see if. Okay, let me change.
Well, I
Sorry.
think if they raise
Okay.
hands, we'll be able to see that.
Okay.
I can start with a question, just taking advantage of my host position. I think Ron, you touched upon this as well, and our speakers briefly touch upon this. There's a big literature just measuring management skill, especially in the fund industry. So going forward, does that mean we should measure skills differently? Should we measure separately the human skills versus the AI skills and their synergy? Because going forward, it's possible that many tradings or even strategy generation and testing are going to be done by algorithms, by bots, by AI agents. How does that fundamentally shape how we measure skills and the labor market, right? The investment profession, labor market itself.
Jinfei, do you want to try to respond?
Yes, excellent. I think, Will, this is excellent and important questions. So that's definitely something that we haven't touched yet, but that's something actually we want to explore potentially, in other projects to look at, how especially the labor market implication. I think there's a huge debate. It's not on my paper, but I think there's a paper showing that definitely at this point. Overall, they are shrinking this entry-level jobs. There's anecdotal evidence showing that the financial companies, they are reducing number of entry-level analyst jobs. So that's the labor market implications. Now, I think a more deeper question is when it comes to measure skills, whether not in the past, right? If it's only done by the team, right? And it's fund manager and a bunch of analysts. Now you have a fund managers, right? And bunch of maybe small number of analysts. Then plus there's AI tools, right? How we decompose these skills, right? So I would say from investor perspective, maybe they will care about the return first. But ultimately, I think it's gonna be really depends on my paper. Actually, all papers show a little bit that there's some complementarity between the AI talent and the tools, right? So I think eventually we're gonna move into to a regime that for fund, right? How good you are depends on how good you managing or using the AI tools in the future, right? Of course, this all make the task that to decompose the AI skill and the human skill challenging, but I think it's super important and interesting.
I don't see other. So while we're waiting for other people to raise their hand, I'll just make a small sort of technical point that I think these diff papers that are using sort of ChatGPT as a shock need to be a bit careful with. So there's this issue of sort of forward-looking bias, and the argument is, okay, like we're going to use only, let's say, ChatGPT 3, which is fine for part of the analysis, but when you get to the part where you're doing the diff and diff, then the pre-sample actually is in the training sample of the ChatGPT, and that could actually bias the diff and diff. And I haven't seen, maybe it's not a big deal, but I haven't seen people actually sort of address that sort of potential bias in the literature. Okay, let's see any.
Ron, can I quickly respond?
Yes.
That's an excellent point. Actually, we in our paper now we have a small section to discuss, not necessarily in differentiative setting, but the locator bias is always an issue for using if you're using ChatGPT. So one way, I'm not saying this we're doing that perfectly. So what we try to do here is we have this knowledge cutoff. So when we're doing this measure, so that's, I'm not saying this just perfectly, but there's some way we can at least do a little bit robustness test. So, but But I think this is an important issue that everyone who using ChatGPT should be aware of that. Yeah.
Pietro?
I have a question for the panelists and the keynote speaker as well, about the risks of new data sources related to Maxime's paper and new technologies in financial market. Because one of my biggest worries is that now it's easier in a way to manipulate the markets. In the past, there was this concern about spoofing, the fact that traders, could place orders and then cancel them to manipulate prices. But now with Gen AI, for example, I can easily see people using, ChatGPT to create a lot of fake articles, a lot of fake news, fake images, right? For example, but I don't know if satellite data can be manipulated, but I can also see the form of alternative data being manipulated. So I was wondering if you think that this is an interesting area of future research, that is the risks that come with these new tools, and what are your thoughts on this?
I'll let the panel first answer, and then if they don't have anything, I'll sort of make. Maxime, do you have anything you want to say?
Yeah, I think that's actually a great question, and we can even like make it a little more broad in the sense that what is the type of information that is reflected in financial markets because of the ability of those data and those tools, right? And this is a little bit the direction that I wanted to point out at the end of my presentation, which is like potentially if you have kind of heterogeneity in the availability of those tools or of the input of those tools, then you might not have the same type of information that is produced on different type of securities or in the market in the aggregate. And I think this is something we should care about because of the fraud, like you said, or because of manipulation, or just because of the fact that even if there's no manipulation, the type of input doesn't reflect the same type of information, the same type of fundamentals, right, on the firms. So I believe that, yes, this potential bifurcation in terms of what type of information are reflected in markets, going a little bit beyond price informativeness, I think, is definitely something we should investigate and is really worth working on. Yeah.
Two small points. One is, I think there's also the other side, in the sense that now it's going to be also easier to detect, because the AI is going to be able to actually sort of detect potential manipulation. So I think it's an interesting sort of trade-off of both the manipulation and the detection of the manipulation. So I think there's actually, both empirically and potentially also on the theory side, there's actually interesting questions to ask here. In fact, I guess many of you might have seen this. I think there was an article, I don't remember if it was in the Wall Street Journal, of someone that had this idea that they're going to generate tons of papers, and those papers are going to cite their own paper. And by doing that, they're going to create, like their citations are going to skyrocket. So that's also going to be, for us as a profession, that's going to be a concern. Will.
Yeah, well, I actually want to follow up on your earlier comments related to equilibrium concept here. I think for any empirical study now on the impact of generative AI, we have a really, really short time series. The way we think about equilibrium might be challenging here. One way to go is to look at a longer historical data set. Many people look into that, right? Counterfactually, had the AI been in place, how writings could improve. I guess for the academic writing analysis, right? One way is to look at the new papers that are written with after the introduction of generative AI. The alternative would be to generate counterfactual papers that could have been written had generative AI been available earlier. The challenge with that is, which is tied to the price impact here. When the managers react, presumably the way asset pricing works could be affected going forward. The factors will be different, and that in turn will affect how firms adopt generative AI and what type of skills are acquired. I just find in general that's That's a challenging problem. We want to figure out a counterfactual equilibrium. We don't have enough data. We can generate data, but then that wouldn't be an equilibrium response. It's tied to Lucas' critique and all that, right? Historical data were not generated under the same environment. Just post that as a sort of open
I agree. I think, this is a very challenging question, but at least my gut feeling is that it is changing the equilibrium. The question is how can people identify those changes given the very short sample that we have, and given the fact that it's on the time series dimension, it's not increasing that fast. Let's see, any other questions?
I actually have a question. I know I'm just the presenter, but I actually have a question for Will and actually for Ron, how to think about in general, where are we heading? So, right, I mean, in terms of we are talking about equilibrium, right? I think in general, the role of one of the role of the financial industry is that they do information production and information, search and price discovery. If we are into a new regime that if ChatGPT is doing many of these information production, but at the same time we know that they just using the human input, right? They're not necessarily they're not necessarily producing informations. So is there any equivalent consequence in that? Is that if more and more content can generated by ChatGPT and less content, few and few content generated by humans, is this are we getting better off or worse off in equilibrium, in the sense that it's possible that fewer original information production by human, but this is going to be actually bad, right? So this, I think we have been talking about upside of having some of the tools, but there could be a potentially big downside of having AI agent or ChatGPT-2 producing and these informations.
Well, first, I think you need to be a bit careful when you say bad or good.
Oh yeah.
Because once you get to welfare statements,
yeah,
then there are going to be some people that it's going to be good for them and some people that's going to be bad for
absolutely.
them, depending on how they take advantage. So you probably, when you're thinking about these things, you want to think more specifically about like price informatives or sort of volatility, for example. I do think that given the fact that potentially, especially you see this like with ChatGPT, that everybody is essentially using the same model, it's gonna, my guess is it's gonna create correlated trades. My guess is it's gonna increase volatility. So volatility will potentially increase. Now, is that good or bad? I think many people will say it's bad, but it would be interesting to see if someone can actually document those changes in terms of sort of impact.
I mean, I agree with Ron about the potential risks. At the same time, I'm more optimistic in the following sense. ChatGPT, well, we talk about hallucination and all that. The power of generative AI is that we allow it to be creative, just like we allow our students, allow our next generation to be creative. So in that sense, I don't view it as fundamentally different in terms of generating new content. Content might be correlated, but if we educate all our students in a similar way, they're going to compute discount rate, the cash flow valuation in a similar way. That also leads to correlated outcome. And at the same time, more AI agents are going to participate in the economy. So they are going to be the players anyway. So understanding how they generate information is useful in that sense. Of course, whether it's with humans or with algorithms, we need to worry about correlated information or action leading to greater systemic risk and all that, for sure. Yeah. In the interest of time, we should probably conclude. I just want to thank all our speakers, panelists, and participants for this event. We do have our next symposium on December 5th. It's going to be a doctoral workshop where we'll feature some job market papers and also have Jerry Holberg as our sort of keynote for that workshop to share with us some advice and research that he and his co-authors have done. So we'll be issuing the information, the call for submissions, and also information about the symposium shortly. So with that, I'm going to conclude today's symposium. Thank you again for joining us. We'll post the recorded video to our YouTube channel.
Thank you, Will. Thank you, Ron.
Thanks.